Welcome to Tradespoon and Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of both companies, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and answer any questions you might have. For those of you who are new, welcome. This is my brief bio. Disclosures are very important. Please read them. You can always pause the screen if you need more time to read the disclosures. I encourage you to do that. I am going to go through market conditions, but also, good morning, Peter, some of the recent trades. So very important to have a trading plan, right? Our goal is to become successful, disciplined trader, right? That can have a repeatable process, find a repeatable process where you always follow the same steps and you can generate partial, part-time or full-time income. So that requires repetition, right? And trading plan. So I encourage you to write down your trading plan and keep a journal. For every trade that you make, document your trade and go through a checklist. What is the most important in that checklist? Cash. I would say number one, right? Because you don't know that will NVIDIA drop another 10 to 20, it's down 25%, it's been down 35%. You do not know if it's going to drop another 10% or it's going to drop, maybe 50%, right? It's not out of a realm of impossibilities. But if you believe in AI and you think long-term this is a good opportunity to buy Broadcom on a sell-off or NVIDIA on sell-off, well, you need cash, right? Because if you don't have cash and NVIDIA drops 35%, you should never buy on margin, right? That would be rule number one. Because even if it drops another 10%, that doesn't mean it cannot drop another 20%. So you always need cash. And the second thing is portfolio drawdown. If NVIDIA drops 35%, the only way you can buy it if you have room in your portfolio to buy it. And the room, especially if you're a new trader, I would propose to have no more than 4 positions and not be down more than 2.5% per position. Because if you have 4 bullish positions and you're down 10% and NVIDIA sells off another 10%, right? You do not want to catch the falling knife. You do not want to break these rules, right? And you have been overly exposed. Because if the narrative changes from soft landing to hard landing, you don't know where the NVIDIA drop is going to end, right? It could be 200-day moving average. It could be below 200-day moving average. So you need the room in your portfolio. So I propose, especially if you start trading 4 positions, no more than 2.5% of account value per position. I propose to always be long and short the market. Right, based on market conditions, you can have more long positions than short. Right now it looks like market is vulnerable for additional pullback, right? From seasonality point of view, from how the market reacts to the news. Right, so if you look at the spiders, right, we're at 544 already. I just finished live trading room 15 minutes ago. And we're already at 544. So we closed the gap. We're below 50-day moving average. And the good news, right? The biggest problem is that we had actually better than expected unemployment data. I mean, we have Fed speakers, right? Maybe he said something negative, I don't know. But it's all about expectation, 25 basis points, 50 basis points. And unemployment data actually come in better than expected, right? The rate dropped from 4.3 to 4.2. Hourly wages went up. But you definitely can see cooling, right? In terms of job openings, right? It continued to decelerate, and the previous months were revised down. So now that market is digesting this news, we are down 544. We are at 62% retracement from lows to highs, basically approaching 50% retracement. QQQ is leading the market to the downside, right? It's already below 50-day, below 50% retracement, 50-day moving average, and already approaching, basically gave up all of the gains since February, right? So QQQ is flat since February, almost probably flat, not flat. We had a strong January. We did have a strong January, but at least since, end of February, we gave up all of the gains, right? In a rather quick fashion. So you don't know where the bottom is, right? Usually you look for a bottoming process. Right now, it doesn't look like it's a bottoming process. It looks like it continues to deteriorate. So, and it's all about 10-year yield, right? I just had a live trading room, right? Martin was there. We were talking about how it reversed back up after the unemployment data to 3.80, but now it drops. Why is the 3.80 is important? Why is the macro important, right? I'm a top to bottom approach. My approach is to look at, it's important where the dollar trades. It's important what yen is doing. And it affects all the stocks, or not all, but majority of the stocks. Some stocks are able to, escape the gravitational pull, right? You have a gravitational pull of macroeconomic conditions, but some stocks like maybe LA Lilly or maybe some themes unable to escape, right? NVIDIA is one of the best of breeds, and it's unable to escape gravitational pull of macroeconomic conditions. So 3.8 is the line in the sand because this is year-to-date low. Anything below that would be considered, and especially that next level of support is 23 lows, right? The 23 lows, which is 3.40. Well, if the Fed is only going to do 25 basis cuts in September and maybe another 2 this year, and the Fed rate is at 5.50 right now, 5.25, 5.50. Well, why are we trading at 3.70, right? Why so market anticipates that in 2 year, right, the 2-year yield, that we will be at 3.70 in the next 10 to 18 months. But Fed did not plan to aggressively cut the rates. So one of the interpretation is that bond market, and at least the bond market tells us that we might not be in a soft landing, we might be in a hard landing. And as long as that is the opinion of the majority of the market participants, market is going to continue to pull back. So it's very important for the yield to hold this level. If this level doesn't hold, we could drop further down. We did look at the gamma levels this morning, right? We looked at the gamma level. Well, first we look at stock forecast toolbox. Stock forecast toolbox yesterday, based on price action, just based on the neural network that we have developed, basically calling for 544 today. And magically we are at 544, right? We're right at 544. Why is that magic? Not magic, but model looks at neural networks and basically looks at the current market conditions and current price action and volume action, and basically says you should not be surprised to see market at 540, right? So we are basically retesting 540 level, and I said, well, if you look at the spiders, and you look at the gamma levels, let's see, NVIDIA. Give me a second. So if you look at the gamma levels, I'm looking at the dealer positioning, right? If you look at first 2 weeks and you look at the September expiration and you look at the October expiration, we do have the largest position is at 540, right? Even if you select all the expiration months, if I go back to all, you can see that 540 is where the biggest position. This is the line in the sand where bulls and bears are going to put up a fight. And majority of that gamma, right, is from the September expiration. So September apex is very important. We're only 2 weeks away, but we're already retesting 540. So personally, I think this is a time to consider, you don't want to follow, catch the falling knife, but as long as we are above this gap, right? This is the buying opportunity, right? 540, 538. I think that level will hold. If this level doesn't hold, we will quickly try to close the gap. Bears will try to close the gap at 530, and there is no positioning. Well, the next level, some positioning 535. And you can see this is a 600 million net gamma versus this is 1.5 gamma, right? 1.5 billion gamma, $1.5 billion are being positioned at 540. So it has to hold this level, right? Because if it doesn't, then I would argue we are revisiting the lows. So that is one observation, right? Even on the good news, market sells off. On the bad news, it cannot. And the most important chart is macro, right? Unwinding of the Japanese yen trade. If you look at the is Bob here? Why didn't Bob show up? He said he's going to be here. If you look at the Japanese yen, it's again resumed its movement to the downside, below 200-day moving average, below 50-day moving average. Probably will on its way to retest the lows. And this is a huge drop, right? From what is this drop of Nikkei? I mean 30% in very short period of time. Biggest drop since Black Friday of 1987, right? It hasn't dropped that much in the past 50 years. Very strong rebound, right? This is physics, right? If you apply strong momentum to the downside, you have a strong momentum to the upside, and then physics takes over again. And now we broke through the 50-200 and decelerating to the downside. That is what's causing the market to pull back, right? You can see yen continues to, US dollar continues to drop compared to the yen, right? We were getting 162 yen for $1. Now we're only getting 142. And we are right at the lows. We are right at the lows, Monday's low, right? That carry trade is what causing the volatility. And NVIDIA is back to, 100 level. And the Bitcoin is dropping, right? All the riskier assets are sitting now on the support and below 200-day moving average. So very vulnerable situation. So the question is, what next, right? We did this last Friday, right? Not much has changed this Friday, right? It's not like there's any new information since last Friday. Unemployment is better than expected. Everybody knew about carry trade. It's all kind of there's no black swan events, at least not now. So we said the scenario number one, we're going higher highs and higher lows, right? This is anytime you have 5 to 10% pullback, going into elections, right? Let's talk about elections, right? It's healthy pullback, and we do have this V-shaped recovery, right? I was surprised by how far we're actually able to rebound, and now we're resuming the move to the downside. So that's scenario number one. Scenario number two, we said we're just trading in the range, right? 10% pullback is healthy. 200-day moving average, reaching 200-day moving is not out of ordinary. We do have, bears do have a point, right? We have restrictive macroeconomic condition where interest rates were restrictive for way too long. Fed is starting to cut in rates, right? But unemployment is still strong, right? Hourly wages went up, right? Manufacturing service data, PMI services data was expanded. People are still shopping. Credit card defaults are, in historically normal level. Even JOLTS data is pre-pandemic level. It's not horrible. For every job opening, you have one candidate, so it's not bad. Even more, 1.1. So basically, these are short-term fluctuations due to seasonality, right? September, October is usually weak, and we're just trading in a range, right? Maybe revisiting the lows, maybe not. And then we're stuck in the range going to elections from seasonality point of view. That's scenario number two. Scenario number three, unemployment data came in better than expected, but maybe inflation jumps, right? Or maybe escalation in geopolitical risk. Maybe the carry trade gets unwound, and over the weekend we find out that we have like a Goldman moment somewhere in Europe, or some major banks goes under because of the large exposure to the the carry trade that's been there for decades, right? And something gets deep, you know, we have some kind of a black swan event, liquidation issue, and you know, we're heading lower. We break through April lows. Consensus on the street, these levels will hold. So this is 510 to 495. This is the big line in the sand, right? This is a multi-months. This is the trend. You know, as long as we are trading in this trend, the bullish trend is intact. If we drop below April lows, then the bullish trend, long-term bullish trend is jeopardized. And then you have scenario number 3, right? 480, 460, something along those lines. Is Kevin here? He always likes to put 4. Kevin is not here. Okay, so those are the 3 scenarios. One, this is just a temporary setback. We've seen it in August. September is no different. We're just gonna have a V-shaped recovery, higher highs, higher lows. There's no signs of recession, right? Unemployment, the employment market is still, you know, strong and normal. So scenario number 1. Scenario number 2, no, there's sign, you know, it's not, we're not sure about 25 basis points, 50 basis points. Next week we have CPI data, then we have Powell decision. 25 basis points, you know, Fed is stuck in the rock and a hard place, right? What's the expression? Stuck in the rock and a hard place, or between a rock and a hard place. Is that if they do only 25 basis points, bears will interpret it that Fed is not doing enough and too late, right? Not enough and too late, and we're gonna, you know, it's the hard landing is soft landing. If they raise by 50 basis points, then the bond market could interpret this. Why are they you know, they said only 100 basis or 75 basis points rate cut this year, but now they're doing 50 at a time. That could signal that the Fed sees something that we don't see, and you know, economy is cooling at much faster rate than everybody thought. That's scenario number 3. All right, so how many of you think it's scenario number 1? Raise your hand. How many of you think it's scenario number 2? How many of you think it's scenario number 3? Two. Thank you, Mark. Appreciate it. Done. 1. 3. Anyone else? 2. 1. Okay, I think everybody wins. We have 1, we have 2, we have 3 is probably equally distributed. A lot of uncertainty, that means that you want to hedge, right? You want to hedge. I'm going to go with 2 right now. I'm going to go with 2, but you know, I'm going to be a buyer probably at 505. Even at short term, if you're a short-term trader, even at 540, I think this is overdone. So I would start maybe thinking about buying at 540 with a very tight stop order, because if over the weekend, or maybe even wait till over the weekend, because I have a feeling that there's going to be some announcement over the weekend. You probably don't want to be long going into the weekend, right? Wait till Monday, make sure we don't have any, you know, black swan events, and then buy close to 540. But I put 2. I actually think 540 will hold maybe for next week or 2. And if it doesn't, then, you know, we are probably revisiting either 520 or 500 level, right? Rather quickly. You can see there's not much support from positioning point of view. We're below 50-day moving average. VIX is at 22. All you need is 1 negative data point. You need 1 negative data point, and, you know, you could have another jump in volatility, right? And I'm more concerned that there is really no positioning up until in only half of the position, right? Or third is at 535, and then let's see, show all strikes. Show, let's do 50 strikes. Yeah. So after 540, you just have kind of equally distributed, not a lot of gamma, right? So I mean, you obviously have 535, you have 530. Let's do this puts and calls, right? So these are the puts, or you know, people either selling calls or buying puts, but not mainly put activity. So you have 535, you have 530, but a lot less than 540. So 540 is a line in the sand, and then all of a sudden there's really no concentration, so we could quickly drop from 530 to 520 to 510 to 500 without any large positioning in place. And in terms of concentration by expiration months, obviously 920 is where you have largest concentration, and after 920, very much less, right? So you have concentration today. People are hedging for the unemployment data, then they're not, and until September. And September, once September expires, then October is pretty low in volume. All right, so what do we do? How do we help? On yellow, on Tradespoon. So we do have different services. One is the stock forecast toolbox. We talked about this morning. You want to have different tools, right? You don't want to rely on stock forecast only. You do not want to rely on seasonality. That usually September, there's a sharp pullback after middle of September. You don't want to rely just on regular technical analysis, right? So we do offer these tools. One is seasonality. You can look at the current price action in the market versus average historical averages on those days. That shows you during apex, just be careful. Market could accelerate the sell-off. So stock forecast toolbox is our main model. You can look at 10-day prediction. You can look at the 6 months prediction. Basically shows you for the 6 months, model calls 520, the low. So I would not be surprised that we're at 520, and we've seen the market overshoot our predictions by 5%. So 520 and 500 would be our basically, the lows, 520 to 500. And model is usually doing a good job finding the highs and lows. So if end of September we're at 520 or 500, that would not be a surprise to me. So those are very useful tool when you're trying to determine how much of your portfolio you want to allocate to these trades. We do have a company screener. You can look on company screener and kind of see which sectors are, outperforming the market, right? Drugs, healthcare has been doing well. Foods and beverages haven't been leading. Insurance, right? You can clearly see out of all of the sectors, if you want to invest, insurance is the strongest sector, right? It's your Allstate, progressives of the world. They are the one that leading the market. Real estate, real estate is leading the market. So you can quickly see which sectors is leading the market. So that's AI. That's our predictive analytics stock forecast toolbox. We went over seasonal charge. I like probability calculator, right? The probability calculator is very useful. 537 by 561 basically showed that the spider will, in the next 50 days, could trade between 537 and 561, one standard deviation. You look at 2 standard deviation, it could be 490, right? 614. So those are the tools. Active trader is what I trade during a week. So, regional banks, NASDAQ, right? One of the strongest stocks that can kind of withstand the gravitational pull is NASDAQ. I mean, not today, it's still pulling back along with the market, but obviously the chart looks extremely strong. So you do have kind of, if you want to be bullish, then probably NASDAQ is where you want to be bullish, right? So you have entry point, right? 168, we're at that level, 168. So this is your entry point divided by dollar cost average, right? And look for 1% move in underlying stock, right? So 1% move, 168 to 169, 1% move to the upside, 1% move to the downside, and split the trade into 2, right? Risk management is extremely important. I propose, especially if you're new, you concentrate on, where is this thing? 4 active positions at a time with 2.5% of risk for account value, right? So on all of our tools, we have these nodes. And again, sometimes stock forecast might not align with active trader, right? Different models, right? Sometimes active trader makes a bullish signal for a NASDAQ, but you look at stock forecast toolbox and NASDAQ is in downtrend. Sometimes it happens, right? Because these are different models. You know, sometimes one model says bullish, one says bearish. So obviously you want it to be aligned, right? You want to go back to stock forecast toolbox and make sure that model is bullish on NASDAQ. Oh, it is bullish, it's part of active trader, okay, things are aligning, right? So that's active trader. If you're not comfortable trading stocks, you can trade options, right? It uses the same entry and exit point. It just uses monthly or weekly options, right? If NASDAQ doesn't have weekly, it will use monthly options and basically say buy, you know, Delta 70, Delta 80 call for $2.30. So 72.30 either stock or option. So that's how you would use active trader services. Sometimes I trade these signals, sometimes I don't. Same goes for weekly trader. These are longer term signals, basically saying what's strong. Well, Costco is strong, right? Costco is on strong uptrend. So if you have a little bit longer term horizon, you know, the stocks that are leading the market, the Costco's and the Walmart of the world. I mean, it's also down today, but you know, down less than the rest of the market. So that's weekly trader. And I actually, if you want to see if I have this position, you can go to Elite Circle and actually look at position type in Costco, and you actually see that I am long Costco, right? This is one of the signals that I did trade, right? You cannot trade all signals because, especially if you're new, you only have 4 positions, so you have to be extremely selective of what signals you take, right? You have to have good reasons why you want to be in Costco versus, let's say, you know, NASDAQ. But you know, if you're looking for signals, this is the place to find signals which are vetted with multiple models. I looked at these signals, Keith looks at these signals, we do statistical analysis and we say these signals are good. If you want to know what I trade, then Elite Circle. In Elite Circle, you can actually see what I trade every day. So Broadcom, where's Broadcom now? If you were in the Broadcom, you know, this was a great trade, right? Great trade, because I looked at the estimated move analysis, right? I looked at the model and basically said, I'm going to be in the butterfly, 135, 130, 135, 140 butterfly. It's extremely cheap to put on this trade. I only risked 23 cents on that put, and I made $1. And right now it's actually trading probably more, a lot more. Oh no, $2. Well, it is a lot more. Yeah, it's trading at $2. Right? So you risk 20 cents and you could have closed for $2 if we close at 135, right? If we actually get to the lows and stay there, then it will be $3.40 that you make. So these are some of the examples of asymmetrical returns where you can put on a trade for 20 cents. I mean, and I also sold the call spread for 35 cents. So I made $1.35 minus 23, so $1.20. Then these are where you can have asymmetrical returns, right? And this is a very important topic because a lot of people ask me, Vlad, I don't care about half a point or 1 point, give me 10 baggers, give me 5 baggers. You know, I invest $1, I want to make 5 or 10% return. This is great. There's nothing wrong with that. But you have to think about distribution of outcomes, right? It's probability of success. I didn't know that Broadcom is going to have bearish news, right? I mean, I thought about this, that was my bias, but I had no idea, right? So you look at distribution of possible outcomes and then you look at the probabilities. When we looked at that Broadcom trade, only 20% of the time I would be break even. So that Broadcom trade yesterday had a probability of 20% being successful, right? But based on market conditions and based on the macro, I thought that today is going to be a volatile day. It makes sense to put on the trade for 20 cents because I could make, you know, $2, $4, and it did work out this way, right? But 20%, only 20% of the time. So if you're looking for these 5 or 10 baggers, just realize probability of success is very small, you know, 10, 20%. Return on capital is very high. You can structure your trade with high probability of success, but low return on capital. You cannot do this, right? Unless you have some alpha and you're Kevin Griffin, right? And you have billions of dollars. And even here, you know, it's not generating 10 baggers. I mean, nice returns, whatever, 20% historical returns. But, you know, there's no trades that gives you high probability of success, high return on capital, unless you're scalping and you have some, you know, you have your servers sitting on exchanges and you have 10 quants from MIT building these crazy AI models, but you have advantage over other hedge funds. Then you can have high probability of success, high return on capital, and consistently making money. In the retail world, this does not happen, right? So if somebody tells you you're gonna make 10 baggers, yes, you could, but with a low probability of success, maybe 10% of the time, maybe 20% of the time, but that's it, right? So based on your profile, based on how aggressive you are as a trader, right? Based on your, you know, you can look at the different profilers for personality profiles, right? Briggs is one of the common ones, but there's a lot of them. Based on where you are on that spectrum, you will gravitate either to this, right? Somebody like me, I gravitate to high probability of success, low return on capital. But you can do this barbell approach where some trades you are looking for this trade, right? You are looking for these trades on some of the trades, but majority of your portfolio is not based on butterfly moving, you know, Broadcom moving 10%. You cannot do that, but you could put 20% of your portfolio into this strategy, and you know, this week was a good week, right? Because, you know, it didn't happen only once, but what else did I do? Broadcom, HPE, right? HPE was actually, I think, break even. HPE too, right? I did do HPE. So HPE was also a successful trade this week, right? I put on a trade, same thing. I received the credit of 25 cents, and I put on a debit of a butterfly for 20 cents, and then I closed it for, 20 cents. So I collected 25 cents. Collected 25 cents on a 20 cents on basically 5 cents credit. There is a risk. There is obviously a risk that on that credit call spread, if HP did have a strong earnings and broke out, I could have lost potentially $5. But again, also happens only 10% of the time, right? When we looked at the probability that HP will close above 20 was only 10% of the time, only 10% of the time. Any questions on the lead circle? We do have morning bell. We have a closing bell. Keith and I are managing these sessions. Keith he's an ex-market maker quant. You know, I think he has master's or PhD in mathematics. Very smart guy. I love working with this guy. So Keith and I, you know, we're backtesting these models. We're doing these live trading rooms. Very unusual business proposition because not only are we build models, but we also trade them. Usually you either have ex-market makers trading using traditional technical indicators, or you have quants showing you the models, but they don't trade them. If you do both, you know, you're kind of like a hedge fund, right? Where you do both, right? You do the quant work, but you actually trade it. So that's a unique proposition. Morning bell, closing bell, daily recording showing all the positions, and you can enter your phone number under SMS alerts, and you get a text message every time I trade. So that's Elite Circle. You can do just Shadow Trader, where you just see all my trades, but you don't have access to the signals. Elite Circle, you get access to everything. If it's overwhelming and you just started, maybe premium portfolios where I trade option spreads, or maybe a robo investor where I only trade stocks. Right? So that would be my proposition for some of the trades. And I don't only trade options. A lot of people say, Vlad, you only trade options. That's not good for me. No, I bought LA Lilly yesterday, right? I'm long LA Lilly, initiated this trade. And I mean, obviously I do have a lot of options positions, but I also bought Costco, right? So it's a combination of stock and options. And, you know, if I'm long JP Morgan, you could be long the stock, right? Just because, you know, it's the same idea. It's just, you don't have to be correct on the time. I have to be correct on the time. The JP Morgan will stay above these levels by October. Any other questions? So we talked about signals, we talked about tools, we talked about models, portfolio that I'm managing that you can follow. We do have a YouTube channel. Every Wednesday we have a live trading broadcast. Please participate in YouTube. And we have a lot of basically free content. You know, if you're not comfortable with options, but you want to learn about them, then you could go into event recordings, right? Go into Active Investor Workshop, type in option, right? You'll see a lot of webinars on options, right? Modern portfolio, weekly versus monthly, butterflies, and you know, and on and on and on. So a lot of free content, education. You know, I come from families of teachers. I used to teach computer science courses, so I believe in free education. You have started guide. We have, you know, different guides, trading guides, smart trading guides, short-term plan, long-term plan, how to use stock forecast toolbox, seasonal chart, etc., etc. Any other questions? How much technical analysis knowledge is needed? Well, you know, there's a reason why Thinkorswim is such a successful company, right? And the title implies that you want to be a subscriber of Tradespoon and you want to rely on our analysis, but ultimately you want to learn yourself, right? Teach someone to fish, you know, don't give them fish, right? You want to have your own opinion. You know, if you don't learn technical analysis, if you don't learn the gamma, you don't learn these things, you rely on somebody else. Just a little, let's say I'm Vlad, I mean, I'm humbled and this is great, but you're going to be a lot more successful if you have, maybe you're not going to learn as much as I or Keith, because we've been doing this for 20 years, but you know, at least you're going to have an opinion about technical analysis. So you want to learn basic price, but you want to know that if spiders broke below 50-day moving average, it's a big deal, right? You want to know that if dollar yen breaks through some of these support levels, long-term support levels, it's a big deal, right? You want to know that if yield drops, right? If you know, if high yield is high, that's a good news for the market. Why is high yield not dropping? Well, there's no panic in the market. So you do want to know, look at these correlations and learn basic technical analysis. I think it's important. But obviously, this is the place to learn. Like if you want to learn from somebody, you definitely want to learn it from Keith or I, right? And if you want one-on-one coaching, we do have one-on-one coaching. So you can always fill out application. And we, we had Scott. Scott is still available if you do one-on-one coaching. So he still, can do that. But you would have to go through this program. And we have other people that teach us this program. Chuck, for cash secure, so the question is cash secure put on NVIDIA. So if you have a large portfolio like Chuck, and you believe in long-term NVIDIA, you could sell, this is the time to sell short puts, right? Let's say 90, right? You can sell 90 put. Let's see, let's look at the, I would not do cash secure put, I would still do a butterfly, right? So it's still sort of vertical. So let's say you want to cash secure put, but we'll pick something that's, so bullish put spread. I would not go to October. I think volatility will stay, but after elections, it makes sense to sell a put. So you go to November, right? And let's say I want to sell, I think 95 level will hold, right? 95 level will hold. So I'm going to put down 95. And then I look at the probabilities, right? If I sell, let's say $10 spread, 95, 85. Where's 95, 85? Here. So if I sell 95, 85, I can collect right now $3. So $2.85, so $3. So 3%. So between now and November, I'm collect 3% premium, and 70% of the time, this would be a break-even time trade. 70% of the time, it will stay above that level by November. 30% of the time, I'm gonna get assigned, right? 30% of the time, I get assigned. So if you don't mind owning NVIDIA at 95 and you are hedged till 85, so you don't have, if there's a black swan event, you don't have to lose sleep if NVIDIA drops below 85. Okay, so then it's a good trade, right? I collect $3, I'm risking $7. I don't mind getting assigned, and I own 100 shares of NVIDIA. So that would be a good trade. It's not cash secured. You could get more if you don't buy that 85 put, but when the market drops like this, right, and you usually have this ABC pattern, right? You have a sharp trade. I mean, at some point will rebound, but you could, that wave C could come, right, where you get it at 90. So then you do cash secured put here, maybe put half of the position, and you put another half position here. But obviously, 100 each contract is $10,000. So you could own it 95, you could own it at 85. You're allocated $20,000 of your portfolio. If you only have $100,000, 20,000 is too much exposure, right? 20% of your portfolio to be in NVIDIA is too much. If you have $200,000 in your portfolio, okay, this is great. Then you don't have too much. If you only have $10,000, well, then you can't get assigned, right? You have to be a trader, right? You cannot afford to be assigned. You can only put on this trade if you believe that the 95 level will hold. I'm not good with patterns. This is the place to learn. I always talk about patterns, chart analysis, technical indicators. I will answer any questions you might have. So sign up for Elite Circle. I would sign up for Elite Circle. I think it's the cheapest way to trade because I believe in education. Even though I trade during this live trading room, I would never say, listen, this is not a good question. So obviously, if you don't know anything about technical analysis, it just might not be enough because we have a lot of people on this live training room. I can't spend a lot of time. I would encourage you to do one-on-one coaching. It costs money, but depending on your portfolio, it could be a fraction of what you're, if you don't know technical analysis, if you're only managing $10,000 in the coaching program, let's say, I don't know what it is, it could be as little as $1,000, it could be as much as $5,000. It just depends where you are. But let's say you don't know anything and you want to invest $2,000, but your portfolio is $10,000. Well, I don't know. I still think it's a good investment because most likely if you don't, you will lose more than 20% of your portfolio at some point, right? So even on $10,000 account, I would say this makes sense. If you have $500 in your account, I mean, then yeah, I would not do one-on-one coaching. I would just participate in this live trading room or on the YouTube. But if you have $100,000, if you have $25,000, we actually give you one of the guarantees. We basically say that look at your performance in the past 6 months. Look at your performance after your coaching completed. Your performance is going to improve by at least the amount of money you invested in coaching. If not, we'll do it again for free. So we stand behind our belief that education is extremely important. It's the same thing if you want to learn how to play chess or ski. Yeah, you can learn how to ski. You can go to Colorado and just ski on blue or black diamonds. But if you never took a coaching class, most likely you're going to fall or maybe even break your knees, right? Or hip or elbow. Do you want to break your elbow? Probably not. Then you better take one-on-one coaching. I mean, trading is the same way. You're not going to have a physical. I mean, I would actually argue you will have physical. If you don't do a coaching, at some point you will have, this fight or flight response, right? We all live through it, right? If you start trading, I don't have that here. I don't have it here. But you will go through some kind of an emotional roller coaster, right? Because if you don't follow the plan and you don't know how far NVIDIA and you're overly exposed, you're gonna have these, NVIDIA is the most popular trade out there. A lot of people got burned, right? When NVIDIA drops 35% in a couple of weeks, a lot of people get out of the game. And there is a psychological and physical roller coaster. So if you want to avoid that, you want to be in the coaching program. All right. That's all I have for today. You guys are awesome. Thank you very much. And I will see you. Keith will do the closing bell, and I will do the Monday morning. Thanks a lot, and have a great weekend.